Picture the spring of 2007. Housing prices had climbed for years without interruption. Real estate seminars packed convention centers, promising ordinary people the secrets to six-figure flips. Television shows celebrated house hunters, bidding wars, and renovation victories. Mortgage brokers handed out loans like candy on Halloween. Financial advisors recommended mortgage-backed securities as safe, high-yield investments. The American dream had been repackaged, securitized, and sold to the world as the safest bet in financial history. But while millions of Americans dreamed of real estate riches, a handful of investors were quietly walking away from the party. They weren't making dramatic exits. No press releases, no public warnings. They simply stopped buying, started selling, and positioned themselves to profit from a collapse they saw coming. These weren't psychics or lucky guessers. They were analysts who read the documents nobody else bothered to read, who understood mathematics that Wall Street wanted to ignore, and who recognized a pattern as old as markets themselves. When credit becomes too easy, when prices rise beyond all reason, when everyone believes the good times will last forever, disaster is already baked into the cake. The smart money always moves first. They see cracks before they become canyons. They smell smoke before the building burns. And in the months and years before September 2008, when Lehman Brothers collapsed and took the global financial system to the brink of destruction, a select few were already positioned. They'd studied the data, they'd made their bets, and they were about to profit spectacularly from other people's ruin. The housing bubble didn't appear overnight. It inflated gradually through the early 2000s, fueled by a perfect storm of low interest rates, reckless lending, and collective delusion. Between 1997 and 2006, at the peak, the price of the typical American house increased by 124%. To put that in perspective, from 1,980 to 2001, the ratio of median home prices to median household income fluctuated between 2.9 and 3.1. That's historical normal. By 2004, it had risen to 4. By 2006, it hit 4.6. Houses weren't getting better. They were simply more expensive because everyone believed they would be more expensive tomorrow. The fuel for this fire was subprime lending. In 2000, there had been $130 billion in subprime mortgage lending, with $55 billion of those loans repackaged as mortgage bonds. By 2005, subprime lending had exploded to $625 billion, with $507 billion finding its way into mortgage bonds. These weren't loans to creditworthy borrowers. These were mortgages given to people with terrible credit histories, minimal income verification, and often no down payment. The industry had names for them. Ninja loans meant no income, no job, no assets. No doc loans required no documentation of ability to repay. The logic was absurd but widely accepted. Lenders made loans to borrowers who clearly couldn't afford them, then immediately sold those loans to Wall Street investment banks. Those banks bundled thousands of these questionable mortgages into securities called mortgage-backed securities, or MBS. But they didn't stop there. They took the riskiest tranches of multiple MBS and bundled them into even more complex instruments called collateralized debt obligations, or CDOs. These were essentially packages of loans made to people who couldn't pay them back, wrapped in mathematical models nobody understood, and stamped with AAA ratings from credit agencies that were paid by the very banks creating them. By 2006, nearly one-third of all mortgages originated were subprime or no documentation loans. The entire financial system had become a pyramid of debt supporting inflated prices. Banks leveraged themselves 30 times over. The Securities and Exchange Commission had loosened regulations in 2004, allowing investment banks with more than $5 billion in assets to leverage, themselves essentially without limit. Bear Stearns, Lehman Brothers, Merrill Lynch, Goldman Sachs, Morgan Stanley all employed leverage ratios that would have been considered dangerous just years earlier. And yet, amid this euphoria, certain investors were reading the fine print. They were seeing something that didn't add up. Michael Burry wasn't the typical Wall Street character. He had trained as a medical doctor, completing his residency in neurology at Stanford before abandoning medicine for finance. He managed a modest hedge fund called Scion Capital from an office in California, far from the towers of Manhattan. While others relied on summaries and ratings, Burry did something almost nobody else bothered to do. He read the actual prospectuses for mortgage-backed securities. These weren't light reading. Hundreds of pages of dense financial language detailing the specific mortgages backing each bond. Most investors, even sophisticated ones, never looked at them. They trusted the ratings. They trusted the banks. Burry didn't trust. He read. And what he saw disturbed him profoundly. By late 2004 and early 2005, Burry's analysis revealed that the mortgages backing these highly rated bonds were garbage. Borrowers with no verified income, adjustable rate mortgages with low teaser rates that would reset to much higher rates in 2 or 3 years, zero down payments. The entire structure assumed housing prices would keep rising forever. If they didn't, defaults would surge. But there was a problem. You can't short a house. Burry needed a way to bet against these mortgages. The solution came in the form of credit default swaps, or CDS. These were essentially insurance contracts. You paid a premium, and if the underlying bond failed, you collected. The beautiful part for Burry was that you didn't need to own the bond. On the 19th of May, 2005, Michael Burry closed his first credit default swap with Deutsche Bank, valued at $60 million. He was betting that subprime mortgage bonds would collapse within 2 years, when those teaser rates expired and borrowers couldn't afford the adjusted payments. To the banks, this looked like free money. Housing prices had never declined nationwide in living memory. The idea that millions of borrowers would default simultaneously seemed impossible. Goldman Sachs, Deutsche Bank, Morgan Stanley all happily took the other side of Burry's trades. By October 2005, Burry had purchased approximately $1 billion in credit default swaps. He'd hand-selected the bonds by reading through the prospectuses and identifying those backed by the absolute worst loans. The banks barely understood what they'd sold him. To them, Burry was an eccentric making a foolish bet. To Burry, he'd cornered the market on disaster insurance at bargain prices. But timing in markets is everything. Through 2006 and into 2007, housing prices kept climbing. Burry's positions required monthly premium payments while showing nothing but losses on paper. His investors revolted. They demanded their money back. Burry refused, placing a moratorium on withdrawals. The pressure was immense. Imagine writing multi-million-dollar checks every month, betting on a catastrophe that hasn't happened yet, while everyone around you profits from the ongoing bubble. Most people would have quit. Burry held firm. His analysis was correct. It was only a matter of time. While Burry was building his positions in 2005, another investor was reaching similar conclusions. John Paulson ran a hedge fund called Paulson & Co. that had focused primarily on merger arbitrage. In 2005, his analyst Paolo Pellegrini brought him research on the housing market that changed everything. Pellegrini's analysis showed the structural weaknesses in subprime lending with brutal clarity. Borrowers were taking out loans they couldn't afford based on the assumption they could refinance when their houses appreciated. But the appreciation was driven by easy credit, not fundamental value. Once lending standards tightened or interest rates rose, the entire system would unravel. Paulson saw the opportunity immediately. He launched credit opportunity funds specifically designed to profit from the housing collapse. The sales pitch was contrarian and uncomfortable. Essentially, he was asking people to profit from mass foreclosures. Initial fundraising was modest. His final fund raised only $147 million, small by hedge fund standards, but enough to implement his strategy. Through 2006 and early 2007, Paulson faced the same challenge as Burry. Housing continued climbing. His credit default swaps required ongoing premium payments while showing losses. Investors grew nervous. But Paulson had studied the fundamentals carefully. The mortgages were bad, the borrowers couldn't pay, the collapse was mathematical, not speculative. Meanwhile, the major banks themselves were beginning to see the warning signs. What separates truly informed insiders from everyone else is access to real-time data. Banks see loan performance daily. They know when delinquencies are rising before it shows up in any public statistics. In May 2006, JP Morgan warned its clients of a housing downturn, especially in subprime. This wasn't a public announcement. This was internal communication to major clients, the kind of intelligence that moves markets if you're paying attention. JP Morgan's analysts were seeing early signs of stress. Default rates were ticking up. The party was ending, even though most people couldn't hear the music stopping. But JP Morgan's warning paled compared to what was happening inside Goldman Sachs. Some of Goldman's traders had been bearish on the housing market since 2004. But in late 2006, something significant happened. Goldman's senior management changed the firm's overall stance on the mortgage market from positive to negative. This wasn't a minor shift. According to documents Goldman later agreed to in legal settlements, by the end of 2006, Goldman employees were observing signs of uncertainty in the residential mortgage market. By March 2007, Goldman had largely halted new purchases of subprime loan pools. Think about the timing. This is March 2007. Lehman Brothers wouldn't collapse until September 2008. That's 18 months of advance warning. But here's where it gets truly remarkable. Goldman didn't just stop buying. Between July 2004 and May 2007, Goldman packaged, sold, and shorted a total of 47 synthetic CDOs with an aggregate face value of $66 billion. These were instruments designed to allow betting on mortgages that had already been made. Goldman was simultaneously selling these products to investors while taking massive short positions betting they would fail. From 2001 to 2007, Goldman Sachs sold $135 billion worth of bonds backed by risky mortgages. Some of these securities were spectacularly bad. In 2007, when analysts were asked to name the worst subprime product sold by a top bank, they selected Goldman's GSAMP, Trust 2006 S3. Within 18 months, 1/6 of the mortgages underlying that bond had defaulted. The Abacus deals became the most infamous. Goldman created synthetic CDOs called Abacus, working with hedge fund manager John Paulson to select the underlying mortgage bonds. Paulson picked the worst performing bonds he could find, essentially loading the Abacus deals with mortgages designed to fail. Goldman then sold these to investors without fully disclosing Paulson's role or his bet against the securities. When the mortgages defaulted, Paulson made approximately $1 billion from Abacus trades. The investors lost everything. By April 2010, at least $5 billion worth of the securities in Goldman's Abacus and similar deals either carried junk ratings or had defaulted entirely. It was legal. It was profitable. And it demonstrated the information asymmetry at the heart of the crisis. Then came the spring of 2007, and vindication arrived for those who'd bet against the market. In February 2007, John Paulson's fund returned 66% in a single month. Subprime borrowers were defaulting in record numbers. The credit default swaps suddenly skyrocketed in value. April 2007 brought the first major casualty. New Century Financial Corporation, the largest subprime lender in America, filed for bankruptcy. July 2007 proved the problem was spreading. Two hedge funds run by Bear Stearns, heavily invested in subprime mortgage-backed securities, lost nearly all their value and filed for bankruptcy. For Michael Burry, vindication came in late 2005 when representatives from Deutsche Bank and Goldman Sachs contacted him asking to buy back the credit default swaps they'd sold him months earlier. They were offering very generous prices. Their sudden interest meant one thing: they'd figured it out. The underlying mortgages were failing, and they wanted to hedge their exposure before it was too late. By the end of 2007, the scale of the smart money success became clear. John Paulson's the flagship fund had gained 590%. Another of his funds was up 353%. The firm's total profits reached approximately $15 billion. Paulson personally earned nearly $4 billion, transforming him from a relatively unknown hedge fund manager into one of the wealthiest investors on Wall Street. Michael Burry's Scion Capital recorded returns around 490%. Burry personally made approximately $100 million, while his investors collectively gained around $700 million. After years of doubt and relentless pressure, Burry's obsessive reading of mortgage prospectuses had paid off spectacularly. Goldman Sachs, having pivoted early and positioned itself short, survived the crisis relatively intact, while competitors collapsed. The firm reported significant profits from its mortgage positions, even as other major banks faced insolvency. But while these few profited, millions suffered. By August 2008, 9% of all mortgages in the United States were in default or foreclosure. Housing prices collapsed. Homeowners found themselves underwater, owing more on their mortgages than their houses were worth. Foreclosure signs sprouted across American suburbs. September 2008 brought the crisis to its climax. Lehman Brothers filed for bankruptcy, the largest in American history. The same week, Merrill Lynch sold itself to Bank of America in an emergency deal to avoid Lehman's fate. American International Group teetered on collapse until the government provided an $85 billion bailout. Washington Mutual and Wachovia failed or were absorbed by competitors. The stock market collapsed. The Dow Jones Industrial Average fell more than 50% from its peak, dropping from over 14,000 points to below 6,500. Credit markets froze. Banks stopped lending to each other, unsure who was solvent. Only massive government intervention, trillions in bailouts and guarantees, prevented a second Great Depression. The smart money had already exited. While Bear Stearns collapsed, while Lehman filed bankruptcy, while millions lost their homes and their savings, the investors who'd seen it coming were counting their profits. The lesson of 2008 isn't subtle. The crisis wasn't unpredictable. The data was available. The prospectuses existed. The mathematics were straightforward. Millions of people were borrowing money they couldn't repay to buy houses they couldn't afford at prices that made no economic sense. But most people didn't see it because most people don't look. They trust. They follow the crowd. They believe the experts on television and the ratings from agencies. They see housing prices rising and conclude they'll keep rising. Fear of missing out overrides every warning sign. The smart money operates differently. They read what others don't read. They analyze what others don't analyze. When Michael Burry spent nights reading mortgage prospectuses that nobody else bothered with, he found what everyone else missed. When Paulson's analyst showed him the structural flaws, Paulson believed the numbers over the narrative. When Goldman Sachs saw delinquency data ticking up in late 2006, they reversed course while the public was still buying. This pattern of information asymmetry repeats in every financial crisis. Before the dot-com bubble burst in 2000, insiders were selling their shares while retail investors were still buying. Before the 1929 crash, wealthy families and experienced investors were liquidating positions while small investors were leveraging themselves to buy more. The mechanics change, but human nature remains constant. The 2008 crisis also revealed something uncomfortable about modern finance. The same institutions that created the toxic securities profited from their collapse. Goldman Sachs sold billions in subprime bonds while betting against them. They had every incentive to create bad products, sell them to unsuspecting clients, and profit from their failure. For individual investors, the takeaway is clear. Watch what insiders do, not what they say. When major banks start reducing exposure to a sector while still recommending it to clients, pay attention. When hedge fund managers known for careful analysis build massive short positions, ask why. The smart money in 2008 made fortunes not through luck or illegal insider trading, but through diligent analysis and contrarian thinking. They saw what was obvious once you bothered to look. They acted on that analysis despite overwhelming skepticism. And they were positioned correctly when reality finally caught up with perception. The pattern will repeat. It always does. Human nature ensures that periods of easy money lead to reckless lending, inflated asset prices, and collective delusion that this time is different. The smart money will recognize the signs, position themselves appropriately, and exit before the crowd realizes the party's over. The only question is whether you'll be watching their moves or following the crowd into the next disaster. If this gave you a new perspective on the 2008 crisis and how financial disasters unfold, hit that subscribe button. The smart money always leaves clues. You just have to know where to look. History has the answers, and understanding the pattern might save you from being on the wrong side of the next crisis.